लाइव है क्या अपन?
I
गॉन
think
लाइव.
it's gone live, right?
ओके
So
ग्रेट.
let's just take few seconds before we start, Vikas. Okay, Vikas, I think we should start. It's already 11. So, shall we? Your mic audio, can you check that?
Yeah, hello
Hello.
everyone. Hi.
Yeah, great. So, thanks everyone for joining in for this OmniScience Capital webinar. Today, the topic is we are looking at the market. Is it a bubble or an opportunity to invest further? Bubble because we have been at nearly all-time highs at index level, and the market has delivered good returns in last few years. So that is an anticipation or a worry that we have seen, coming from various investors. So we wanted to address that head on, and we also would like to take this, time to discuss what are the future opportunities or good market segments that we are looking at, where we think, fresh capital can be allocated at this time, and we will have a discussion on the questions that we have received already. A lot of questions have come regarding various aspects. So we'll take that during our discussion today. And if you have any questions, you can write them on the chat, and we'll be happy to take those questions as well. So, without taking much time, I think I'll put it back to Vikas. Vikas, over to you. I'll be changing the slides, so you let me know whenever you want me to
Super,
change.
super.
Yeah.
So welcome everyone. Thanks, Ashwini. And the question we have been receiving the most formally, informally, right? And that's the question on most people's mind most of the time. And this has been there for a year or so. Is, are we in a bubble, right? So are we in a bubble, or what should we do? Should we take out cash from the market? Should we invest lump sum, or should we invest SIP, or and so on and so forth? And that is a question we want to address first, so that the macro view or the overall view in that sense is clear to people, or at least what is our view is clear to people. So we can go to the next slide. So, I mean, whether such a thing is there, number one, we can't see the future, right? Nobody can see the future, and nor can a fund manager see the future. We are all human beings. We cannot tell you what is going to happen. Only maybe Lord Ganesha knows what is going to happen. But another way to answer that or to address that is a mental model from Charlie Munger, who adopted it from a mathematician called Carl Jacobi. always invert, right? So let's invert the question that what would make sure that there was a bubble and that it would crash? What are the conditions required for that? Okay. So if we put the conditions down which are required for a bubble and then see whether how many of those are true, we will be able to get a picture of what is the situation today. Okay. So let's move to the next slide. So these are some of the conditions. Now imagine, how do you get to a bubble? To get to a bubble, first of all, you have a situation where for last several years you are doing very good economic growth. So the second bullet point, if you see, accelerating GDP growth. So for last several years you should have accelerating, not only high GDP growth, it's increasing. So the GDP growth itself is increasing. So previous 3 years back, there should be some GDP growth rate. 2 years back, it should be higher. 1 year back, it should be still higher growth rate. Okay, so it's accelerating, because of which means the huge demand is coming. Because huge demand is coming, the utilization of capacity of the companies is happening. Because of that, they will start doing capex, right? So to do capex, they will be borrowing from the banks. The banks are lending them. Interest rates are low during these high growth years, right? So that is encouraging investment. Demand is high, so that is encouraging investment. But of course, when you do capex, it takes 3, 4, 5 years before it can start producing. So during this period, the demand keeps going up, but supply is not coming. And because of this demand supply mismatch, inflation comes in, right? So inflation is now high. Okay, so accelerating GDP growth for last several years, high capex by companies, high lending by banks, right? I mean, that is related, right? Unless the banks lend, the corporates cannot borrow. So those two things are twin things. And then inflation goes high. When inflation goes high, the central bank like RBI or Fed has to start increasing the interest rates to control the inflation. And on top of this, because companies are continuously reporting high revenues, high earnings growth, etc., and they are doing huge capex, they are extremely bullish and positive on the future. So market could be overvalued. So at some point, market is overvalued. At this point, and when you get to a interest rate hike cycle, so initially the central bank like RBI would keep increasing the interest rates and nothing will happen. And eventually, when market is overvalued and interest rates are hiked significantly, the bubble bursts. These are the conditions to make a bubble and then to burst it. Okay, hope I am clear. So again, to summarize very, very quickly, a bubble is created when there is continuous high GDP growth rate, accelerating GDP growth rate, backed by a huge amount of capital investments by corporates or government, and borrowing by the lending by the banks. And because of demand supply mismatch, there is huge inflation. And now the central bank is started increasing the interest rate. So you are on the up cycle. You just started on the up cycle. And market is extremely bullish. And so it's gone into huge overvaluation. When all of these things are together happening, the pinprick is the high interest rates by the central bank. As you keep increasing, that pricks the bubble. The bubble is the whole economy being in a high debt environment and market being overvalued. So I hope I have clarified that. Now let's look at the data, where we are. So high inflation. Now look at the inflation data here. We are at a significantly low inflation scenario. It's below 4%. Okay, approximately 4%. So that for India is a very reasonable or low inflation environment. RBI's mandate, in fact, is to keep it at 4% or in the range of 2 to 6% band, right? So the inflation situation is not uh, showing a bubble. Next one, accelerating GDP. Now, if you see 2021 was a low GDP growth rate, but that was because of the COVID. Besides that, it's just like a flat. So it's around 7 to 8% kind of growth rate, but it's consistent. It's not accelerating as of now. So we are far away from that situation. Now the capex. So banks' capacity to lend is very, very high. The capital adequacy ratio for banks, RBI wants it to be 9%. Now it's upwards of 14%. Let's go to corporates borrowing capacity. Again, we will see that actually the debt to equity has been decreasing for last several years. So the borrowing capacity of corporates is increasing. So rather than that they are at the end of a long cycle of investments, rather we are at the beginning of a cycle of investments for the companies. Okay. Interest rates. So interest rates are again have been flat for more than a year, and now we are on the verge of a interest rate cut cycle rather than an interest rate hike cycle. Completely opposite to what burst the bubble. Okay. And then the last one is the market overvalued. So market is today at, I can't read it from here, but it looks close to around 20 something, right? 23 or 24, just below 25. So Nifty is just below 25, and compared to, let's say, 17 to 19, when it was significantly above 25, we are way below 20. I mean, not way below, but just below 25. So even on the market, excuse me, even on the overvaluation front, at least the Nifty 50 is not showing crazy overvaluation. Of course, the mid cap and small caps are hugely overvalued. But if your large cap itself, which is the major, investment destination for the institutional investors, whether domestic or foreign, the large amount of capital, the larger capital you're sitting on, institutional capital, it goes to the large caps. And the large caps are not overvalued. Okay. So, but overall, if you say market is overvalued, yes, we would say that yes, market is anticipating too much. Okay. But in short, in summary, we've listed 6 criteria which all have to come together to make a bubble and then burst it. Right now, only market overvaluation looks like the place. And on an overall basis, if you want to say, yes, market is overvalued. On a specific stock by stock, you can even today create a portfolio which is significantly below its intrinsic value. So I hope that is addressed. More can be addressed when the Q&A happens. Okay. Now, second thing is, a lot of questions come. Again, we will address that in the Q&A as well. But a lot of people have some, especially on small case investors have this maybe a wrong learning of what is a small case supposed to do, what is a small case manager supposed to do, etc. People think that once they invest, the small case is supposed to go up. If the fund manager is doing his job right, it should go up from next day or the same day. Secondly, not a single stock in that should fall. Third, if it falls, that the manager should throw out that stock and replace it with a stock which goes up. So let me tell you, that is not at all the job of the fund manager. That is not what you can do. Okay. There are strategies which try to do that, which are called momentum strategies or technical trading strategies. We do not follow those. The reason we do not follow those, and again, I mean, everyone in the market has their different styles of investing, etc. So We're not trying to say anything bad about the other strategies, to each his own strategy, but our belief system is that that doesn't work. We want to, our objective is to outperform the market over the long term, which is 3 to 5+ years. For that, we believe what we call the scientific investing framework works. And there are some key characteristics which we have laid down as bullet points here. Of course, there are many videos, many write-ups, articles we write in the media and everything. You can see continuously we keep talking about the scientific investing framework. And we'll do separate sessions again on those. But some of the key characteristics are that the companies in the portfolio should have strong balance sheets. So low debt, high cash, ideally, right? Persistent competitive advantage, which means that the company is highly capital efficient. Okay. All of that is summarized. The persistent competitive advantage, we can talk a lot about it, but finally it is coming down to high capital efficiency. Third is that the company should have a large growth opportunity. And last is that each company should be available at a large discount to its intrinsic value. So this in brief is what we are trying to do. The implications of this very quickly I'll tell you. Many times why I am getting something below its intrinsic value. So something is worth 100 rupees, we are trying to buy at 50 rupees, right? So why will I get something at 50 rupees? Because Mr. Market, rest of the market is negative about it. They don't like it for some reason. We also understand that reason, but we don't believe that reason justifies such a low price. Okay, we think that's either a temporary reason or a wrong analysis, or the quantification of the problem is wrong by the Mr. Market. So somewhere we believe Mr. Market is wrong. We are right. All the fundamentals support a high intrinsic value, while market is selling it at low. When we buy this, it is quite likely that after buying, it will go down for some time. Okay, so you could see a negative situation in the portfolio because of that. That is possible. But over the long term, we believe after that initial negativity is gone, chances are that it's going to deliver even from the higher price level where we bought it. And then it fell, right? From the price level we bought it or we recommended it, we expect that the market will reprice it to significantly above its intrinsic value. Of course, we'll not wait to cross intrinsic value. We will be out of the stock most likely somewhere close to fair value. Again, remember that intrinsic value is a range. It's a range. So the lower thing is when you are very conservative, and the higher thing is when you are optimistic about the assumptions. Even slight change will create a large, big range. Okay. So somewhere below the lower level we want to buy, and as it crosses to higher level we want to sell. Okay, I hope the philosophy is clear, and people who expect that every day the stock will go up if fund manager is charging fees for it, and that somehow rebalance is a magic to do it. No, that's not the case. Rebalance we do every quarter. We go through the whole market when the financials of all the companies are reported. So we go through all the companies in the market and try to pick the best companies. And then we compare it with the portfolio. And if there is a company which is much better than what is in the portfolio, that tends to come in. And if a company is there closer to its intrinsic value, it goes out. Or if a better deal is available outside the portfolio, that comes in, and something which is not such an amazing deal anymore because it has appreciated in price, it goes out. So I hope we have explained our investment philosophy and the rebalancing and what to expect from it. Let's move to next. So now where is the opportunity? Okay. So where is the opportunity? We have arranged this by inverse of PE ratio. Okay. So we are not saying, we have made videos on PE ratio also, and we are not saying that just PE ratio is everything. But P ratio, when you don't have any other information, P ratio is the best indicator of future returns. Lot of people on small case or even otherwise, I mean, even mutual fund investors and all that I've seen, people are very hung up on the past performance. SEBI clearly mandates that past performance is no indicator of the future performance. And there is a reason for it. Okay. In fact, the best indicator of future performance, in our opinion, is P ratio. And inverse of P means E by P is earnings yield. So the highest earnings yield or the lowest P ratio is on the right here. Okay. You can see where my arrow is, where my cursor is. And that's a what we call capital enablers. Okay. So that has the lowest P in our set of things. Next, you go to there is a high dividend, super dividend portfolio. And then the next one is power, right? So again, power has very high yield or low P. And then you come here and you will see that the P is roughly, earnings yield is more than 5%, which means P is below 20, somewhere here, okay? Which is our small cap portfolio. And then you have Nifty 100. Nifty 100 is roughly at a 30 P. And Nifty multi-cap is even higher P, okay? 33 maybe. So you will see that most of our strategies are low P. And in our opinion, low P indicates higher future expected returns. There's no guarantee, but that is the future expected return. Then you come here. So defense portfolio is roughly similar to just slightly higher than the multi-cap. Then the IT portfolio is also somewhere here. And then the railway portfolio. Okay. But all of them are better than, like if you see the Nifty Defense Index, that's the lowest yield. It's above 50p. And then Nifty Mid Cap is there, which is probably 47p or something. And then Nifty Small Cap, which is also very high p. And then our technology, railways, defense. Okay. So I hope I've explained to you. Let me explain one more thing. So we can go to some other slide. No, so let's go to the previous slide. Yeah, let's stay here. So I don't want to confuse people with anything on the screen. So where do returns come from? So returns come from three sources. First is the yield. I just talked to you about earnings yield, right? E by P. So all of that E by P is not available to you as investors. What is the free cash flow yield is available to you. So after doing the capex, whatever is remaining, that is available to investors. So E by P, some portion of that yield comes to you. That is what is generating returns. Next is the growth. So growth is very important part. So a company which is growing at 10% versus company which is growing at 15%. You're getting 5% extra return from the growth component, assuming that the yields are same. And the third one is re-rating. This is the most important one. So suppose the company is growing at 15% and it should be, let's say, justified at a 25p. I'm just throwing some numbers for illustration. So let's say 15% grower available at a 4% yield, right? 25p means 4% yield. So 4% out of which, let's say 2% is available to you, to the investors, rest will be used for capex. So 2% from there, 15% from growth. So 15 plus 2, 17. And then now let's say the market thinks that a 30p is justified for this. So re-rating happens from 25 to 30. So you get a 20% extra return on top of 17%. So 2% yield, free cash flow yield, 15% growth rate, 70, plus now 20% is available. Let's say it happens in 1 year, then you get a 37% return. Let's say it happens over 2 years, so 10% each year. So that's 27% return. Suppose it takes 3 years, so around 6 or 7% excess return. So 17 plus, let's say 7. So 23, 24% returns. Let's say it happens over 5 years. So roughly 4% extra. So around 20, 21% returns. So I hope you understand that the biggest driver of extra returns are growth and re-rating. And for re-rating, you need to have a low P portfolio. If it's not a lower P portfolio compared to what it should be, right? So given the growth rate, it should be low P compared to that particular growth rate. It should be mispriced. And then you get the extraordinary returns from re-rating. And that you have seen in some of our portfolios or a lot of our portfolios, right? So over a 3-year period, you will see a significant amount of you can see a significant amount of re-rating happening in our portfolios, right? So now coming back to again the opportunity, why we think the low PE or the high earning yield portfolios are placed for better returns, you can clearly see where our capital enabler and power portfolios today. Something similar was there for defense and railways, let's say 3 to 5 years back. So naturally, it generated extraordinary returns. So the only value of looking at past performance of any strategy is to understand that does the strategy have the capability to deliver high returns? Don't look at the numbers. Is it that when consistently the same strategy like scientific investing framework across different sectors, across different growth vectors, across different themes is able to deliver extraordinarily high returns compared to the benchmark, then naturally that can give you the way to use that past performance is to come to the confidence level that yes, because so many of the strategies driven by scientific investing framework have delivered, so I have higher confidence that there is something strong in scientific investing framework. That is the only use of past performance. Okay. Yeah, you can go.
Yeah, great. I think because we can take up a few questions at this point.
Perfect. Super.
There is we have touched upon you have touched upon nicely on various aspects of how the portfolios are being managed at OmniScience Capital, how incentive investing works. But still, there is, and I'm trying to bunch up few questions into different buckets so that
Yeah.
we can address them in one go. So one set of questions are related to the recent performance is not that great, or the portfolio has gone down after the rebalancing, or why there is a large churn in the last rebalancing in certain small cases. So I think you have explained this, but for just if you can kind of reiterate, that,
Yeah.
so it will be helpful, I guess.
Yeah. So again, let me address that. Why is it going down? Okay. So if there must be investors who are asking such questions, then naturally they are thinking that somehow the small case should always go up. Okay. Number one. And if it's not going up, the fund manager should do some magic, which is called rebalancing. And after the rebalance, the stocks should all go up. Okay. So this, as I explained, the only or the short-term trading strategies, technical trend following strategies, technical analysis, momentum, quant, some of these things, basically they are all trying to do trend following, okay, or I can call it momentum. And they're trying to see that whatever stocks are going up in last 15-20 days, we just buy those so that they hopefully continue for 15-20 days. And they will say that okay, there's some thought process behind it, maybe there is, right? We don't agree with that philosophy, as I mentioned. To each his own. I'm not criticizing. I'm just trying to explain we do not do that. We're not trying to outperform in the near term. We're not trying to sell the stock which has gone down in the portfolio and buy a stock which is going up in the market. No, that is not what we are trying to do. What we are trying to do is rather we are taking advantage of such people, right? We want to take alpha is getting generated by going against such people. We are trying to buy something worth 100 rupees for 50 rupees. Simple. And we expect that Mr. Market will realize it over next 6 months, 1 year, 2 year, 3 year, or 5 years. Worst. Somewhere in that range, Mr. Market will realize that this is not worth 50. This is worth 100, but this was worth 100 in year one. By now, it's probably worth even 200, right? If it's 3 years plus. So something like that is what we are trying to do. And so why there is a large churn recently is because, as I mentioned, every 3 months, once all financials are out, we go through a deep dive through the market. If we find better investment opportunities outside the portfolio, then the portfolio will be changed. If only one stock is outside which is better, that can come in. If 3 stocks inside are not so good, they will go out. If 5 stocks outside are good, they will come in. So I hope we have explained that how we rebalance. And do we expect that as soon as we rebalance, it will go up? There is no such expectation. We shouldn't expect that. Because we are buying stocks which actually is market is mispricing. Market doesn't understand that this is worth 100. For some reason, it's selling it at 50. Even at 50, it's not happy. It thinks maybe it is even 30 rupees worth, right? And so it's selling. We are buying because we think it's worth 100 and it will be worth even more few years down the line, maybe even 150 or 200, right? Because of the growth opportunities. And so this is the difference in what we do and what market thinks.
Great. So the next set of questions are around, what are the opportunities? Maybe we'll come to that. But one common thing again is that, how much to allocate, what should be the maximum value allocated to certain small cases, and should we stagger or should we go lump sum? These are also, investors' questions.
Yeah. So, see, as I explained, especially in regards to us, is that we have some core investment strategies, right? Large cap, mid cap, small cap, flexi cap, multi asset. So, those kind of things, roughly 40 to 60% of your total equity portfolio can be allocated to these core strategies. Again, I mean, don't allocate if you have 100 rupees in equity markets and through direct stocks, through PMS, through mutual fund, whatever. If you have 100 rupees, I'm in equity markets, I'm talking about 40 or 50 rupees in our core strategies or in our or everyone else's core put together. So if you're putting into some mid cap or flexi cap mutual fund, that is also counted here. So that should be at least 40, 50 or 60 rupees out of the 100. Okay. So out of this 40, 50, 60, if you're only going by OmniSciences things, then this should be a mix of large, mid, small cap or flexi cap or something like Amrit Kal or some broad-based strategy. That is one. Next, coming to each thematic. So any thematic strategy from anyone, we think it should not exceed 10% of your total equity. So if you had 100 rupees in equity across mutual fund, PMS, small cases, across all managers, don't put more than 10%, 10 rupees in any sector, whether it's a sector mutual fund, whether it's a sector or thematic small case. Put 10 rupees. Okay. And if it crosses to 15 rupees or more, or 15% or 20% of your portfolio, you should trim it and bring it back below or equal to 10%. I hope that is very, very clear, which means you should have at least 4 to 5 different thematics in your portfolio. So there is core of 50, and then remaining 50, 10, 10 each in 5 thematics. And then every 6 months or a year, you review it. And if it's reached these things, right? 10 has gone to 15%, etc. You trim it and bring it back. So I hope that is clear.
Right. And in terms of going lump sum or staggering it, like there is a related question, which says that how do you protect yourself against a bubble? Let's say if it is a bubble,
Hmm.
and especially let's say if there is a crash because of a black swan or something, how do you
Hmm.
protect your portfolio?
No, no. See, that is the whole thing. Why risky asset classes deliver higher returns? This is exactly the reason why equities deliver high returns, is because equities are exposed to this kind of risk, right? That the market could go into a bubble, and then eventually the bubble could burst and then remain down for 6 months, 1 year, 2 years, 3 years, or even 5 years or more. Right? That is why people say you should come into the market for the long term, and then you get rewarded for taking that risk. There is no protection against these things. The protection comes at a cost. So if you try to do protect, then you don't know anything. You're saying, oh, I don't know, maybe it will fall. So I will put 20% in cash, I'll put 50% in cash. On what basis are you saying? We have already gone through the data, right? So there is no data. Only out of 6 factors we discussed, only one of them, which is market overvaluation, is at best, which we can say is favoring that a bubble is there and it could crash. All the other factors are against it. So now, for whatever reason, you say, no, no, I don't know anything, I don't understand, and so I will go into cash. So you can remain in cash. Now that cash is not delivering you any returns during that period. So suppose you assume a market is going to crash, but many people have assumed over last 3 years, right? Multiple times. Every single month or every single week, there would be a different reason why people would say that the market is going to correct or crash, and they would go into cash, right? Now, if you go 20% in cash, only 80% of your portfolio is delivering. If you go 50% in cash, then 50% of portfolio is delivering. If you go 100% in cash and market keeps going up, what do you do? If market goes down, I understand you will be very happy and invest. But then you should be very clear. So that's what we are trying to say. First thing itself, I said nobody can predict where the market is going to be. And that's why whatever money you need within next 2, 3, 5 years, that money has to be in cash or debt or low risk investments. Whatever money you don't need for next 5 years is supposed to be in equity markets, and that will generate the returns. Then you don't second guess that portion also. Now the question of lump sum versus SIP, in general, if you see market is going up, right? For last 50 years or whatever, you will see market in general is going up. So in an uptrending market, if you do a SIP, you are buying later at a higher and higher price. Okay, it's logical, right? That today market is at 100. Let's say 1 year later it's at 120. 1 year later it's at 127, 130, let's say. So if you do a systematic plan, you are buying at a higher and higher price in general. So if you have spare cash, normally it makes sense to go lump sum. Yes, if you don't understand, you're very jittery, you can always spread it out over next several months. That is possible, even a full year. If you are a retiree and you just got your big retirement amount, then I will not tell you that you go and invest it lump sum. because you are never going to earn more money, let's say. Then you divide this and do a SIP over next 1 or 2 years. And of course, you take a consultant, financial planner and do all those things before allocating a single rupee.
Okay, so quite a few questions have come on, what are the attractive sectors, to look at this point in time, and where people can allocate capital. So I think this chart, which is there, which will explain or can guide people, to look at small cases that are available at higher earnings yield or attractive valuation in other words. But we recently also have released a couple of reports. So, as you can see on this slide, the capital enablers, banking related small cases are having the highest yield, earnings yield, and the power portfolio. So, these two reports are available on our website, and they they highlight the key investment rationale that for the banking and housing finance companies, it's a twin balance sheet opportunity where the banks have a large lending capacity because their capital adequacy ratios are at nearly, at very high levels, way beyond what RBI mandates them to keep. Uh, and Similarly, the corporates are able to borrow because they are having a stronger balance sheet compared to, let's say, last 10 years. And then there is a growth opportunity which is coming from various infrastructure push that the government has undertaken. So that's a great opportunity. There is similarly, we have discussed the investment rationale for the power sector and power offering, where we expect double-digit growth to happen for both capital, the demand for the power, as well as we are pretty bullish looking at the capacity addition, and a lot of capacity addition is coming on the renewable side. So renewables, the more adoption of electric vehicles, and setting up of data centers in India, these are the growth vectors that are going to drive this particular growth vector in for the next many years. But I so while there are, we'll have specific, you can look at our specific videos which we have released on each of our offering or market outlook on specific sectors. But I want to ask, now, because uh, there is a lot of questions on two of our small cases which are quite popular. One is the defense and bullet train, which is on the railway infrastructure. That these two, have seen some correction in the last few months. Let's say from July onwards. Uh, so how should investors, allocate to these two small cases and the way forward?
Yeah, yeah. So see, just it's corrected. So that's a better opportunity than earlier. Okay, because it's now available at a lower price, right? So that is one part. Now, as I mentioned, there are three drivers of returns, which is the free cash flow yield, which is some percentage of the earnings yield, right? Free cash flow yield plus growth plus re-rating. Now, the extraordinary return of defense and railways was because 3 to 5 years back when we started, they had the huge growth opportunity. They were at extremely high yield. And then over last 3 years, the re-rating happened, right? Growth happened, re-rating happened, and the free cash flow yield was available. So, but the highest return generator was growth and re-rating. Today, if you ask me, the re-rating portion is gone, right? Because they are now closer to fair value. Every time we rebalance, we try to introduce stocks which are at significant discount to intrinsic value, and we try to remove stocks or reduce exposure to the stocks which are closer to intrinsic value. So But still, overall, the defense and railway portfolio are closer to market kind of P, right? Which means that the re-rating potential is not so much available, but growth remains intact. The growth opportunity of getting returns in defense and railway is intact. If you come to banking and power or housing finance, etc., capital enablers, then we think all three things are available, right? That high yield is available, high growth is available, and the potential for re-rating. So where defense and railways were, let's say, 3 to 5 years back, we think today the banking and power is there. So if I was an investor, and let's say my risk profile and all that is all taken care of, discussed, etc., and I have 100 rupees in equity, and I put 10 rupees in defense, let's say, and now it's 15 rupees or 20 rupees, I would definitely take out the extra 5 or 10 rupees from defense, and I would prefer to put it in banking on power or something. Okay. I could even look at reducing the defense exposure from 10 rupees to 5 rupees, same way for railways, and put that extra into banking and power. That is how I think. Okay. Ashwini, we cannot hear you.
Oh, sorry, I was on mute.
Yeah, for
So
last. Last one.
one question is on Omni Flexi Cap. Why that small case has been taken away? Uh, So, you see, our intent is to offer a set of core as well as thematic opportunities, and in the form of large cap, the Royals, Knights, and Supertron, there is a better capital allocation capability in terms of, you can allocate to both, all three segments of the market. So, flexi cap can be built by allocating to these three small cases. That's the idea. And apart from that, there are multiple, growth vector oriented thematic opportunities. Maybe Vikas, if you want to add something.
Yeah, and see, that helps you choose which specific market cap you want to take exposure to. So even if you go by Nifty large cap, Nifty mid cap, Nifty small cap, today the mid cap is like 45 or 50 P, right? And Nifty large cap would be 30 P, and Nifty small cap would be 35 or 40 P, right? Something like that. So as compared to that, we have given you like Omni large cap strategy, which is way below 20. All our large, mid, and small cap, all three are available below 20 P. Uh, People who feel more risk averse, they want to be with the larger companies, they can take higher exposure. So large caps is something which you can take single exposure, I think. Okay, for the core. Somebody wants to add uh, like potentially higher returns to that, they can add mid or small cap, right? So this is how you can configure on your own. So by giving large, mid, and small separately, you are able to have more flexibility on how much exposure you want to each segment of the market.
Because there is a question asking why small case over mutual fund, AIF, or PMS, or how they are different.
Yeah. So number one, they're completely different. So mutual fund, they pool money from lot of investors, and then they are buying and selling and investing. So which creates very large pools of 1,000 crores, 10,000 crores, 50,000 crores, etc. Okay, that is one thing. Keep in mind that typically a mutual fund is a very large corpus. That large corpus forces them to buy large cap companies more, right? So they have to go by more or less the index, and they can be slightly overweight or underweight the index. So if some company is 3% in the index and the fund manager in a mutual fund is bullish on it, he will buy 4% of it or maybe 5% of it. And if, let's say it's 3%, but he is bearish on it, he doesn't like the company, he'll still buy it more or less. Most of the fund managers will still buy it, but they will allocate maybe 0.5%, 1%, or 2%. So this is how a typical mutual fund works. Some fund managers in mutual funds will go to 0 instead of 3% if they don't like the company, right? And even if a company is not even in the index, they like it, they might buy it. So that is exception. Normally, they will be going slightly overweight or underweight the index because of the sheer large amount of capital they are getting. They cannot deviate too much. Okay, that is number one. Number two is because they are buying and selling, this is favorable to mutual fund investors because they are continuously buying and selling. The tax implication remains within the mutual fund, it doesn't come to the investor. This is positive seemingly, but it's also a negative. Okay, because anyway, you pay taxes only on your profits. Okay, so when you are buying directly, there will be periods when you make a lot of profits. There will be periods when you make a lot of losses, like in a small case when you're buying equity directly. So whatever losses you make during the bad phase of the markets, those losses you can carry forward for tax purposes in future. And when future gains happen, you can adjust them. Again, I'm not a tax expert, but I'm just giving you the general guideline you have to consider. So this is one of the differences in the mutual fund versus small case. Okay. Secondly, sometimes, like in a small case, so I think that's one of the main differences. I'll go to the most important difference. So I'll illustrate it with an example. Like we started buying the defense stocks in our flexi cap portfolio somewhere around 2019, 2020, Ashwini.
Yeah, absolutely.
Yeah. And then we launched on January 6th or 7th, 2021, the Omni defense portfolio, right? Bharat Defense or something. And I think somewhere end of 21 or beginning of 22, Nifty Defense Index was launched.
Jan 22, yeah.
Jan 22. So exactly 1 year later, after we launched small case. So I'm explaining why small case works. Okay. So we launched it. 1 year later, the index from Nifty comes for the same concept. Before we launched, defense was not even considered a sector in India. Okay. Investable sector. Now Nifty launches the index, which means now they think that there is a sector. Now what happens? Next, a mutual fund launched a defense fund. When was that?
Yeah, June.
Don't name it.
June
Sorry?
23, June 23, the first mutual fund scheme came.
So 1.5 years after the index is launched and 2.5 years after we launched the small case. Okay, fine. So the first fund comes. Next, how many funds were launched after that? If you have a time, like dates.
I don't have the timeline, but recently, in the last, let's say, 6 months, 3 more funds have come, 3 or 4.
Three or four funds have come. Okay, so you can see that by the time mutual funds are able to launch, it's already the real returns, which, as I mentioned, come from re-rating. Those are over. Okay. I don't remember, of course, but and I can be wrong in my memory. But when we launched our Omni Bharat Defense, the PE must be below 10. Okay. Probably 5 or 6. Today, Nifty Defense Index PE is upward of 50. Probably 52 or 53, if I'm not wrong. So this is something where you can see the advantage of small case, that new ideas, themes which are not recognized by rest of the market will be available to you through small case, can be available to you much faster, and you can take exposure. And when rest of the world is ready, you actually are ready to get out. When they are launching the mutual funds or index funds or ETFs, that's the time when you are getting out of those funds or reducing exposure.
Yeah. I think one more point can be highlighted because is on the current portfolio itself, right? So there are multiple options today, let's say for defense, but if you look at the funds or let's say the index, and the funds are kind of very close to the valuation levels where the index is, and some of the funds are actually index funds only. So we are talking about like a 50 plus 55, 60 PE, which the other defense portfolios are at, while we have with our rebalances and the way we have tweaked the portfolio, we have closer to 30, right? There is a significant difference. Like if you continue to allocate to this theme, and you're allocating because there is a great growth opportunity. It is a sustained long-term growth opportunity, and that's why you want to take exposure. But with our approach, you are still not taking a very high price risk, right? That things are becoming overvalued. We will continue to remain part of the index, or if the so there is a differentiation in the strategy and how you approach and manage risk while taking exposure to a growth opportunity, also not managing the price risk. Right? So so there's a question on the outlook on the IT sector. Again, IT is our focus area as well. So maybe we can touch upon that.
So IT sector, when we say the biggest opportunity earlier was the cloud, right? Digital transformation, then movement to the cloud, and today the opportunity is artificial intelligence, right? So while the cloud opportunity still exists, a very large number of Fortune 500 is still not migrated fully to the cloud. At best, you could say somewhere between 30 to 50%, you can say they have migrated their data infrastructure to the cloud, right? So remaining is still there. Then digital transformation journey is also a long journey, long way for those Fortune 500 companies to go. And then the third, which is AI, which is going to be a multi-decadal opportunity, right? And it's not theoretical. Companies like Nvidia are selling the chips. Companies like Amazon with their AWS cloud infrastructure, they are buying the chips for their cloud infrastructure. Microsoft Azure buying the chips for their cloud infrastructure. Google Cloud buying the chips for their cloud infrastructure to add AI capabilities. So these three are the largest players in cloud, right? Together they are, let's say, 2/3 of the cloud business. Why are they buying? Why are they investing? And we are talking of literally hundreds of billions of dollars they're investing over multiple years. They're going to now rent this out, right? On a per processing cycles, whatever they bill to the Fortune 500. So they anticipate huge demand coming from Fortune 500. That's why they are investing in this, and they will resell it to the Fortune 500 over next several years and make money. The problem is Fortune 500 doesn't have capability, number one, to move themselves to the cloud, nor do they have capability to do themselves their digital transformation, nor definitely they don't have the capability to use AI. For all these things, they have to go to what is called technology service providers, such as the Indian IT companies, as well as handful of 4 or 5 international companies, right? So that whole opportunity is available to the Indian IT companies, and we expect 15% plus kind of growth rates over the long term, CAGR basis, CAGR basis. 15%, maybe even 20% over next 10 years plus. Okay, so we think that opportunity is huge. And everyone should have some exposure to technology. You can't go to zero because technology is disrupting everything else. So if you go to zero in the disruptor, then your portfolio is not going to look so great. Right? So this is one part of it, the technology part. Yeah.
Great. I think we have reached the end of our discussion today, because maybe with some final closing notes, we can end the webinar. And I've tried to take many questions, but there could be certain questions which are not answered. So you can obviously, we'll try and reach out to you wherever there are specific questions or some technical details that you have asked. Otherwise, you please drop us an email, so we'll be happy to revert on that, or call us at number. And yeah, I think I would like to thank everyone for joining in at this point, and over to you, Vikas, for your closing comments.
So one issue which we've not addressed, so I'll just address that as well. The Middle East war situation, right? And it seems to be escalating, and people are saying what will happen and all that. So number one, go back to Russia-Ukraine war, and that time also people were worried, and now we know what happened post that. Here, there are some implications. Number one, obviously for India, crude oil price it as is at risk, right? So the price could go up overall because of tensions in the Middle East. Number two, chemicals related to, and these are things which we import mostly in India. So those things will be impacted, could be impacted. Number one. Number two, and which naturally means that RBI is going to not cut the interest rates, even though we are in a verge of a rate cutting cycle. This could slow down the RBI's path, right? If they are worried about inflation. Second part is Middle East also has the sea lanes from Asia to Europe, right? From Suez Canal and all that. So the problem is if there is disruption in the supply chain from Asia to Europe, Europe gets exposed to supply chain disruption, which means again some inflation risk. These European banks also have to worry about not cutting interest rates that quickly. Now, completely different point is there is a strike called the longshoremen strike or the dockyard workers strike happening in the US. So all the ports are on strike. There is no inflow or outflow happening in the US ports. And we are sitting in October. Festive season for them is December, right? Starting from end of November, which is Thanksgiving, to Christmas, to New Year. So during such a crucial period when a lot of stuff is coming in, they are disrupting the inflows and outflows. And there is election time. Okay. Festive season, election time, and you are creating a disruption. So the Fed, which was virtually guaranteed to cut interest rates every single meeting for next several meetings, now is going to be a little bit worried because inflation caused the earlier inflation cycle. I mean, supply chain disruption caused the earlier inflation cycle. Now again, we are looking at disruption. So they'll be waiting and watching. So just keep these two slightly negative factors. So the interest rate cuts, which we were expecting very fast, it's going to be slightly slower for some time. Okay, that is what we think. Otherwise, we don't think this is a very long thing. But for next 1 or 2 months, we have to watch how this settles down. Okay, we do think that most likely the Middle East war will be absorbed. The market will digest it and then go on like the Ukraine-Russia thing. Supply chain will not be allowed to get disrupted as much, most likely. Same way, the strike will also be settled in US. So in general, we expect that once the elections are over on November 8th in US, things will again settle down. Okay. So we think there is like a few weeks of little bit of uncertainty, which will settle down in a month or two.
Great. So to end, I would like to read the important disclosures and disclaimers, and especially, uh, for all investors, it is important to focus and understand that investment in security market are subject to market risks. Read all the related documents carefully before investing. And registration granted by SEBI members of membership of BASL and certification from NISL is no way guarantee performance of the intermediary or provide any assurance of returns to any investor. So, with that, thank you all for joining in. Have a good day.
Thank you.